Well, good morning. I'm Jaginder Rana. The topic for the discussion today is insurance of business enterprises. Insurance of business enterprises. Insurance protects against misfortunes that affect a person and his assets. Insurance can also help out in protecting large and small industries, ships, aeroplanes, factories, hotels, or even small shops. In the world around us, we see a lot of small, medium, and large enterprises. The word enterprises usually means a complex company, business, or project. Some enterprises are worth crores of rupees, operating across the country and are run by the government or by large business houses, while some are locally run small businesses. So enterprises may do various activities like producing things like medicines, furnitures, manufacturing equipments like vehicles, televisions, processing like making jam out of fruits, pickles, or marketing goods and services, etc. So most of the enterprises that we see around us are usually small enterprises which do not or which do their businesses in a small way locally. Now let us look at the enterprises that we see near us. A hotel, a bakery, or a provision shop is set up by an entrepreneur or businessman by investing his money for the purpose of earning money. However, in this process, he has to face various risks, like business-related risks. It is possible that the food prepared does not taste good, and no one comes to eat in the hotel. Or customers may develop a liking for some other type of food and may not come to the bakery to buy cakes or biscuits. Or nobody visits the provision store when there is weekly market nearby and provisions are available at low prices. So these are business related risks that an entrepreneur can expect and take caution against as part of building his business. He can always try to compete with others in the market by making better food, reducing prices, making new varieties of cake, etc. so that he attracts more customers for his products. Such risks are normal business risks or risk, and are generally not insurable. Now let us look at other type of risk that he is facing. Say risk from natural calamities. The hotel may be destroyed by an earthquake. The bakery could be washed away by floods, and a fire can destroy the provision shop. So though he is all along exposed to such risk which can ruin him completely, the entrepreneur can do practically nothing about these, as all these are events beyond his control. So insurance can take care of such risks that are chance events beyond human control. The interesting part about these events is that though these can happen anytime, these may not happen to one enterprise all the time. So rather, though all shops are always exposed to the risk of an accidental fire, in the normal case, the fire will actually strike only a very few shops in a small town, and that too only once in a long period of time. So such risks are always there, but their occurrence would be unexpected or accidental. And if the event happens, the loss can be defined and measured. So insurance takes care of this second set of risks that are unpredictable or chance event. In the context of a shop, insurance works when the risks are shared by a large number of shopkeepers. So by the system of insurance, the risk of a large number of similar shopkeepers exposed to same type of risks get pooled together. All of them contribute small amounts towards insurance. So if any of these shopkeepers are affected by the insured risk, their loss is compensated from the pooled contribution. So in operation, an insurance company takes over the specific risks of a large number or shopkeepers and collects premiums from all of them. So the insurance company takes care of the fund, and when the loss occurs, pays the value of the loss to the shopkeeper. Now, by their own studies, insurers know the kind of risks different categories of enterprises are exposed to. So they have accordingly devised certain packages policies for the ready use of certain groups. There are package policies for industries, factories, commercial premises, farmers, householders, and shopkeepers, etc. Say, for example, shopkeepers package policy. Now, a shopkeeper's package policy is designed to insure all the insurable risks of a large number of shopkeepers. It provides wide coverage against various accidental happenings like fire, earthquake, lightning, flood, burglary, etc. So the policy gives cover for the building, its content, money kept in the shop, etc. Based on the specific requirements of shopkeepers and on payment of additional premium, they can take additional coverage for others. Risk like losses due to dishonesty by employees, losses due to incapacity to do normal business activity soon after a loss or damage to the shop, building due to fire, burglary, etc. Damage to the neon sign and glow signboards of the shops. And legal liability to any third party arising out of insured business. So the cost of policy or the premium is determined on the basis of the type of insurance policy and cover selected. It broadly depends upon the perils specific events that can cause a loss covered, the coverage obtained, the value of the items covered, the deductibles, the part of loss that the insured agrees to bear himself obtained, construction of building, nature of occupancy, the location of property and contents of the shop, etc. So, There is a case, for example, case study, the industrial disaster and insurance protection. This is a story of industrial disaster vis-a-vis insurance protection. Union Carbide India Limited established a pesticide manufacturing plant in Bhopal during 1970s. Pesticides are chemical to protect crops from getting damaged by pests. These chemicals are highly poisonous. On the night of December 3rd, 1984, a poisonous gas, namely methyl isocyanate, started leaking from a tank at Union Carbide India Limited Bhopal plant. Now, leakage of this gas claimed approximately 3,800 lives, as per official report, and thousands of people became sick and suffered from several health-related problems. Now, as we know, human life is invaluable and the true price of a life cannot be compensated. But the company was legally bound to pay compensation to the kith and kins, dependents of the victims who died due to this major event. Now, Union Carbide of India Limited was made to compensate the damages, and they had to spend a huge amount of money on account of the legal battle for the damages payable due to happening of this event. So as a part of risk management, having insurance helps to make good the losses. Insurance also helps to assess the risk, which indirectly ensures adequate preventive measures needed as precautions for avoidance of such accidents. In case of the unfortunate happening of the event, by having insurance, losses can be minimized as consequent financial liabilities could be transferred to the insurer. So eventually the chain of events led to the introduction of Public Liability Insurance Act in India. The main objective of the Public Liability Insurance Act 1991 is to provide for damages to victims of an accident which occurs as a result of handling of any hazardous substances. So the Act applies to all owners associated with the production of handling of any hazardous chemicals. Now, in such a situation, the company's workmen's compensation policy takes care of the liabilities of the company to its employees. Under liability insurance, the insurance company would similarly take care of the company's liability to the public. Further, if the 3,800 people who died had life insurance policies, so their families would have received some financial benefit to tide over the financial loss due to their sudden death. Personal accident policies would have given compensations for death and disabilities as well. So if the thousands of sick people had health policies, their treatment cost would have been met by insurers. So this is a case study which shows how the insurance work and provide the protection to the business houses or the risk faced by these business enterprises. Thank you. Thank you very much.